Welcome back to Trading Wars. Thanks for joining me today. Today, I'm going to be sharing a free Fibonacci reversal strategy. The reason I'm sharing this strategy is because I've sold over 75 copies of my book, and I promised that if you guys showed me support, that I would continue to give you solid strategies and concepts that you can use in the markets every week to earn profits. So thank you very much for the support. And this strategy is dedicated to everyone that's supporting me. All right. So let's get started and let's step into the war zone. So the Fibonacci reversal strategy is a strategy that's taking advantage of when algorithms sell at measured moves. That's basically what it does. So the algorithms purchase at specific retracements and they sell at specific extensions. Okay. So as an example, I have, let's say here that we have an impulsive leg in one direction, and then we have a pullback, right? So if I were to draw the Fibonacci, and we're going to go through many examples, but I wanted to show you guys using this. This is the perfect best case scenario example. So we have one move, we pull back to the 50, and then we trade to the 272 extension, and then from here we have a reversal. So this is what this strategy is aimed at doing, is taking advantages of these reversal opportunities, because as the algorithms purchase at the 50% retracement or any of these retracements, they need a place to be programmed to sell in order to cover profits. And when they sell, we take advantage of that dump, because through my years in the market, I've seen this happen many times where after a measured move, new traders and rookies will be looking to buy the breakout over here, and they'll be quickly reversed on and stopped out. So I don't want you guys to be one of those traders that are always chasing and have FOMO. Instead, we can master the art of the reversal. Okay. So again, this works because of the algorithms program to buy at specific retracements and to dump at specific extensions. Usually they dump anywhere between the 10% to about the 50%. So in this zone here, okay? So in general, new highs or new lows in the market, depending on the trend, will bring two type of traders. Reversal traders will show up when we make a new high, as well as algorithms will be dumping their positions. And then the third thing that happens is new traders buy the breakout. And if we start to break down back into this zone, they will also get stopped out. So that's what we see. That's why this strategy works, because there's a combination of multiple factors playing out. Okay. So, and then I'm just going to quickly draw it for the short side for you guys, so you can see how that works from the other direction. So it's the same thing. So let's say we have a push down like this, and then we have a pullback, and like so. And then we must have a new leg. So we always must have a new high or a new low in order for the reversal strategy to work, because we want to take advantage when the algorithms are getting rid of their positions, so that we can take that opportunity to trade a reversal. So here's an example here of pulling back to the 618, trading to the 272. Let's bring this one down a little lower, because sometimes it can look like this, coming down to the 50% and then having a reversal opportunity here. Okay. So the frequency of this, if you're day trading it on SPY futures, in general, most stocks, you'll see this opportunity between 2 to 3 times per week. It doesn't work all the time, but the win rate is pretty high. I would say between 50 to 60%. And some weeks it's a perfect strategy, because some weeks the market is just reversing. And I know a lot of you have been through that. So I'm showing you how you can take advantage of that. The risk to reward is very good because you're getting in at the potential turning point. So that's why I really like the strategy. And how to enter the trades, you can use limit orders or candlesticks. And I'm going to talk to you guys about that through all the examples we go through. So you must know how to draw the fib, right? And if you're still struggling with that, I have the whole YouTube playlist on Fibonacci, so check that out. And if you want a lot of examples, then you have to check out my book, because in my book I have over 75 charts. Okay, nobody does that in their books. They'll have 5 charts. I have 75 charts in my book teaching you how to draw fibs and showing you examples, because that's how you learn. you have to have screen time and chart time. Okay, so let's get into all the examples, and then let's look at the risk to reward and the potential. Okay, so I'm going to start off looking at SPY, and then we're going to look at, we're going to start off on a 5-minute for day trading, and then we're going to look at the hourly, and we're going to look at some other stocks and other instruments. Okay, so the first thing you have to be able to do is you have to be able to draw the fib, like you said, and you have to identify when a new leg in the market is being formed. Okay, so we're going to start off here. So I've picked a few samples that we can go through. And like I said, it happens anywhere between 2 to 3 times a week. So I'm going to get rid of this fib, and we're going to draw this together. Okay. So this is the 29th of December. So if we look at this chart very clearly, we can see a big push down, and then we can see the pullback, and then we can see trading to a new low. So this is the type of pattern we're looking for. So how do we get involved? So we take the Fibonacci from the high to the low, and then we notice here that we have a 50% retracement, and then we trade. Look where we trade. We trade right to this 382 extension, and then we pop. Okay, so from a limit order perspective, I have a few variations. So whichever you choose to use, that depends on the instrument that you're trading. Okay, so you have to do a little back test to see which one works the best, because every instrument is going to trade differently. For SPY, this area here, this 272, is where if I'm using a limit order, I'll place a resting limit order there. Okay, so that means that before all of this happens, I'm already planning that when it comes here, it's going to reverse. Okay. And my stop loss, if I'm aggressive, it's going to be below the 50. If I'm conservative, it's going to be below the 618. Okay. And what we're going to do here, in most of the times, I'm going to use the 50, but I don't put it exactly on the 50. I put it a little bit lower, because sometimes it will touch this 50. Okay. So this is an example of coming in with a limit order, right? And in this case, that was a very easy one-to-one risk to reward. And a lot of times, if you catch this, this could be a major pivot, and we can actually have 2 or 3 or 4 times our reward, which I'll show you in a few examples. But the main thing is, this is also a very safe entry, because look where we're getting in and look where the stop is. So at any point, I could put my stop over. Now I can put my stop below this candle here and not lose a lot of money on the trade. Okay, so that's option 1. Option 2 is waiting for the candlestick confirmation. So when we get to these extensions, we're looking for particular patterns. So in this case, it's very straightforward. At the 382, we see a nice doji, right, with wicks on both sides. That's a reversal pattern. So that would be where you can enter from the candlestick, or you can wait until you get a more stronger pattern, like here. Now we have a double bottom. Okay, and the way you would enter there, just take the candlestick entry. So watch my candlestick videos on YouTube if you are not familiar with that. And that's an easy, 2 or 3 R, which is a great winner. So that's how you trade it with candlesticks, depending on how conservative you want to be. So that's one example. Let's go to the other one. So here's another example where we have this initial push in the morning, right? So we take the Fibonacci from the low to the high. We pull it all the way across so we can see, right? And then we come to the 382, and then we make a double bottom, and then we push into new highs. Okay, so in this particular case here, if you have a limit order on the 272, you're not going to get filled. But when we get up in this area, we have a really nice pattern. We have this doji again right at the top, right? So you can just use the candlestick entry here. You can put your stop above the 272 or above the candle, like so, and do something like this. And then if you get that and you're able to go into the close at the very lows, that's above 6R, which is amazing. Or the other thing that I like to do as well is use this 10% line. So this 10% line is something that I've tested and I've basically created it on myself because I've seen that usually about 10% of the extension of the leg, there's going to be some selling. So another way is just if you want to be very, very aggressive, you can just front run at the 10% mark and then put your stop in. I wouldn't do the 50 because that might be a little bit too far away. What I would do is do above the 382. So that's another way of doing it. So like I said, guys, you have to do a little bit of back testing on the instrument you're using to see which ones work the best. But nonetheless, you can see that when we get to these important Fibonacci zones, we have a lot of reversals because of why is that happening? Well, the algorithms that bought here, they need to cover their profits. The algorithms that bought here, they need to cover their profits. This is why we have reversals. And at the same time, we have the rookies. The rookies buy here. They buy into new highs. And this is the market makers taking advantage of them. This is the market makers taking advantage of the rookies that are shorting now. They're looking, new low, I'm shorting. The market is going to crash. That's what it takes advantage of, okay? So now let's look at some more examples. So this is another really nice example here. So we had this first leg, we had the pullback to the 786 doji right here. Then we pushed through, traded to the 382. And at the 382, we had a big sell-off, massive sell-off. So this is the best case scenario when we have algorithms completely dump their positions and it just becomes so powerful and that there's no buyers left in the market and we have this huge drop. So from the limit order perspective, you come in here, you short the 272 or the 10%. The main thing is make sure your stop, is in a good place. And for me, if I'm on the 272, I'm putting my stop a little bit above the 50, right up here. And then look at this. If we were able to take this all the way down, that's 8.6R. That's crazy. So if you want to wait for the candlestick, look how beautiful this pattern is here. We have a nice inverted hammer. It doesn't get better than that, right? And then we have another one. So inverted hammer, doji, another inverted hammer. You just play the candlestick, entry above the high, entry below the low. Take this one down. That's almost 20R. So that's insane. That's actually insane. It's a really good strategy because the risk to reward is really good. And you don't need, if it happens 2 to 3 times a week and you get, 5R on each one, you're good to go. Okay. All right. Now let's look at this one. So this is an example of the 10% being the area of reversal. So we had this big push from the open into the afternoon. We pull back to the 50%. We trade where to the 10% extension. And then we have all of these wicks here showing the buying power. And then we just squeeze back right up into the close. So this is an example, again, algorithms dumping, new short traders coming in and getting screwed over because the rookies are always trying to do breakout trading. And then we have the reversal there. Okay. Here's another example here. This one is a really nice example. So we have this morning leg reversal back to the 618. We trade exactly to the 272. You see that, guys? It touches it, and it just rips. So if that's not proof that algorithms are, using measured moves and using predetermined levels, I don't know what else will convince you. But again, here, enter on the 272, stop below the 50. Or you can take a candlestick pattern. You can even take this big candle here if you want to, and you still make a little bit of money. Okay, so that's awesome. So this is the pros and cons of using a limit order versus a candle. If you use a limit order, sometimes it's going to touch it like this and you're going to be filled and you're going to feel like a god. But sometimes it's not going to be that clean and it would be better to wait for the candles. So whatever you do, just be consistent, whichever style you choose. Okay, here's another example here using the 10%. So we had this push up, we had this pull back to the 618. We trade over to the 10%, and then we fall over here. Okay, guys. So this is another good example. Sorry, I think I misspoke on this one. So sorry, the push is from. Let me just adjust this. It's from here's the low to the high to the 382. We test it once, twice. We make a new high, 10%. We fail, and then we roll over. That's another great example. And look, you can clearly see the reversal here. Look at these dojis, 1, 2, 3 dojis with wicks to the top. All right, so that's SPY. I'm going to show you an example of ES on the hourly. So this happens on all time frames. So this was one that I actually called out a few weeks back. we had this original push down like this. We had this pull back to the 786, and then we traded exactly to the 50% extension. Look at that, right? So this is proof that the algorithms are there. Why does it reverse exactly at these levels? Why? And then over here, if you're looking for the candlestick, I also call this out live. You have a double inside bar pattern, absolutely stunningly beautiful. And if we look back on that low, where are we now? Beautiful, right? So some of these trades, if you want to go for home runs on the bigger time frames, let's say we went in here at the 272, stop below the 50, right? A little bit below, like I say. And then if we were able to hold that, you know, that's 12, 13R. Beautiful. Okay. Now let's look at Adobe. So this is Adobe on the daily chart. So this is an example of the bigger picture, right? So we have this push down, we have this retracement to the 786, and then we trade to the 10% extension right in the zone. And then from here, this is the reversal. So you can use this on anything, okay? It's a very good strategy. I'm giving it to you guys for free because of all the support that I've been getting. Otherwise, you know, I wouldn't be sharing these things because it takes me so long to learn and a lot of work that I put in to get these strategies, okay? And then here's an example of gold. Here's the daily chart. We have this initial push down, pull back to the 50, trade to the 272, and now we're pushing back up. So it's a very, very powerful strategy. All right, so just to summarize, so the concept again is algorithms, they're using measured moves to purchase or sell positions, and at the end of the measured move, there's a high chance of a reversal. So the frequency on a day trading time frame is about 2 to 3 times a week. The win rate is about 50 to 60%, sometimes higher, depending on the week, depending on the context of the market. But what makes it a good strategy is the risk to reward is very good. You can use limit orders, you can use candlesticks, and that's pretty much it. So thanks for your time. And if you enjoy this and you want more free strategies, please comment, like, and subscribe. It really, really helped me. I'm trying to get to 1,000 followers this year on YouTube. I'm at 700 and something. So, you know, I think with the content that I give, I think I deserve it, really, because I don't really see people breaking things down the way I do. All right. And then the last thing, if you want to learn more about fibs and you want more examples, please consider purchasing my book. Details are on my website, and you could DM me on Twitter for more details. Okay. Thank you very much. And I hope you enjoy the rest of your day.